What's up, guys? Jay Martin here, investor and CEO of Cambridge House. And my guest today is Jared Dillian, the editor of the daily Dirtnap, the phenomenal investment newsletter. Plus, Jared's a fantastic personality to follow on Twitter. You should do that. He's also a best-selling author, very, very busy guy. And we get into his whole background, what he did before he got into finance. This is a super fun conversation. We covered precious metals, Bitcoin, inflation, the macro finance landscape, where he's spending his time and energy and his cash, most importantly. And it was super fun, so I hope you enjoy it. Now, 3 things before we jump in. Number 1, this YouTube channel now generates significant ad revenue. I didn't see that coming, but it does. That's great. What I've decided to do with that cash is donate it to an organization that is super close to my heart called Zero Ceiling. Zero Ceiling's mission is to end youth homelessness. The way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness areas and then surround them with employment training, supportive housing, and just generally positive influences on their life. So check them out if you're interested in Zero Ceiling. They're great. Number 2, if you prefer to listen to my content as opposed to watch it, you can now find me wherever you listen to your podcast. Just search for The Jay Martin Show. And number 3, beneath this video, there is a pinned comment where you can subscribe to my weekly newsletter where I ramble at you once a week, every Friday. Probably my favorite thing that I do is write this letter. I love it. I recap everything I learned from these conversations, any moves I'm making in the market, but just generally share my opinions on what's happening in the world, and it's super fun. So check that out in the pinned comment below. Here is Jared Dillian. Enjoy.
This is Jay Martin.
All right, guys. Jay Martin here, investor and CEO of Cambridge House. I'm joined right now by Jared Dillian. Jared, how are you?
Pretty good. Pretty good.
Now, for anybody who's watching this, who's not familiar with who you are and what you do, could we start there? Like, how do you spend your time, Jared?
Yeah, I used to be a trader at Lehman Brothers in the 2000s. I left at the bankruptcy to start my newsletter, which is the daily Dirtnap. I've been doing that for 13 years. I have a little over 4,000 subscribers. I also write for Mauldin Economics, have a couple of newsletters with them. I have the 10th Man newsletter, which is a free letter that goes out to 100,000 people. I'm going to grad school right now. I'm getting a MFA in creative writing, so that's kind of fun. I'm also a musician. I'm a DJ. I do parties 3 or 4 times a year. Got a lot of music on SoundCloud, which you can check out. I'm called Stochastic, so you can look up Stochastic on SoundCloud. So I do a bunch of different stuff. But the main thing is the daily Dirtnap, which is the sort of the flagship newsletter. Yeah.
Okay. I want to talk about that a little bit. What do readers get? What do you publish? What do you talk about?
Well, it's really it's kind of hard to describe. It's sort of a macro / multi-strategy newsletter with a big focus on sentiment and psychology. That's the thing I do best, is focusing on investor psychology and using sentiment for setups and turning points to do trades and stuff like that.
Yeah. Okay. And just to shout out your letter, I think your like renewal rate on your letter is something ridiculous, like mid 90%, which is
it's like 92%. Yeah.
Okay, for context, that's unheard of in the publishing business. So congrats, man. Obviously, what you're writing is sticking to people. Yeah.
Thanks.
Which is so important, So we have a lot of retail investors that watch this show, Jared, and one key piece of advice I love to pass to people is you need to find, a quote unquote guru, but a personality in the space that you resonate with, more so than just provides you with insight and education and market data. Because if you don't love how they're delivering the information, you won't stick with it, right? And if you don't stick with it, then forget it, right? Like, the life of an investor should be a lifelong endeavor, right? It needs to become one of your habits, just like fitness, right? You don't go to the gym and get ripped in a month. It's got to be a lifelong protocol, lifelong habit. Investing is the same. In order to let that education compound, you got to find educators who write in a way that you want to receive it, right? And then to go back for more each week or whatever, and you'll stick with it. That's the key piece of this game, I think.
Yeah. And the other thing about that is, especially with newsletters, I'm not omniscient. I'm not infallible. I get things wrong. So if you read somebody for a period of time, you kind of get a sense of when their reasoning is sound and when it's flawed. And you kind of know when the newsletter writer is right or is making a mistake. So people use newsletters in all different kinds of ways. Some people subscribe to newsletters written by guys that are wrong all the time. because they like to do the opposite. So however you get value out of it is up to you.
Hold on. So people that subscribe to a newsletter writer who is notoriously wrong so that they can action the opposite advice, or what is that what you're saying?
Yeah, that's what I'm saying. Yeah.
That's pretty wild. Love that. I want to know who these people are.
And actually, I will say that, having done this for 13 years, my subscriptions tend to go up slightly when I am wrong, when I am making mistakes, because people get to say, okay, I'm right, that guy's wrong, and they feel better about themselves, and they're actually like more willing to keep subscribing. It's counterintuitive, but I found that to be true over the last 13 years.
So therefore, you must get responses from people who are opposing your point of view and arguing your data, arguing your forecast. Is that right?
Yeah. I mean, having said that, now that I've been doing this for so long and I got some gray hair, I could tell people to smear themselves in peanut butter and run through a dog park and they would probably do it, right. But so I don't get as much pushback as I used to, but I still do.
You don't get as much pushback as you used to. Okay. But what about, I find today there's more and more things that I say that are automatically categorized as controversial, right? Or maybe an opinion I have that I wouldn't think is a strong controversial opinion is perceived as one, right? People are more sensitive suddenly, specifically in the last 18 months. We could, draw reasons why there, but they're more sensitive to opposed opinions than I've ever seen them before. And conflicting ideas and the art of the debate is like lost, because as soon as we hear an opinion we disagree with today, we turn our back and dismiss that person as being an idiot. But, is that a trend that you're seeing as well? Like, does that speak to you?
Look, it speaks to me on Twitter, but in terms of my business, I write in such a way that, I qualify things. I'm like, look, this is what I think, but I could be wrong. This is what my experience tells me, but, the opposite could happen. And people are generally pretty forgiving about that kinds of stuff. I don't talk about politics in the newsletter. Some people do that. I just completely stay away from it. Sometimes it's kind of inevitable when you're talking about, fiscal policy or monetary policy, and it kind of drags politics into it. But I don't really thrive on conflict or controversy.
Got it. Yeah. Okay. Now, you focus on sentiment, you focus on investor psychology. So what are some trends that are top of mind for you right now? What's catching your attention?
Well, a couple things. First of all, just going back in history a little bit, very early on in the pandemic, probably around April of 2020, I started making a very loud and noisy call that we were going to get lots and lots of inflation, based on the stimulus money that was being, pumped into the economy, the PPP loans, the Fed cut rates to zero. I said, we're going to get lots and lots of inflation. And inflation is 100% a psychological phenomenon. It's absolutely a psychological phenomenon. If people expect prices to go down, prices will go down. If people expect prices to go up, prices will go up. So what I identified at the time was that the psychology behind inflation, we had deflation or disinflation really for 40 years, and the price of things were going down. And I said, I identified that turn in psychology.
What 40-year period are you discussing when you say that?
Really from 1980 to 2020.
So, but would you include financial assets or hard assets in that category of deflation?
No, I'm just talking about the CPI basket.
Okay, got it. All right. Yeah, that's interesting. So from your perspective, then sentiment can really drive market activity, right? That's what you're saying?
Yeah, and what you're seeing right now is people believe that prices are going to continue to go higher. So this is my favorite example. Let's say you're going to Lowe's and you're going to buy a bag of fertilizer, which is $8. Okay, so you get there and there's a bunch of fertilizer, and you say, well, the price is going to go up. We have inflation, so instead of buying one bag, I'm going to buy 10 bags.
Yes,
and I'm going to store 9 in my basement. And the act of everybody doing that at the same time, buying more than they need and hoarding, we are in this vicious cycle where prices continue to go up. And the only way to break that psychology basically is to do what Volcker did in 1979, which was raise rates a lot and cause a recession. The only thing that's going to stop the inflation is a recession, a very severe one. That's the only thing that's going to stop the inflationary psychology.
Yeah, okay, that makes complete sense. The self-perpetuating cycle of inflation, because I would do the same thing. I mean, I'm in a different way, but maybe I'm looking at hard assets that I just feel like the inflation trade, if it's a 5-10 year trade, I know exactly where I want my money, right? At least part of it. Let's start with that, actually. How do you play this? Do you believe, what's your time horizon for this inflation cycle, Jared? And if so, like, how would you allocate cash?
Well, it's going to be with us for a long period of time. 10 to 20 years anyway. I mean, this is like long wave economic cycles, right? This isn't just a 1 or 2 year phenomenon. This is going to last 10 and 20 years. Like, I think it's possible that the Fed could hike to 1.5% or 2% next year, invert the curve. We have maybe a mild recession. I think that could slow inflation down. I think inflation could get back down to 4%, but I don't see 1 to 2% inflation anytime in the next 20 years. I mean, it's here to stay. Okay. So the second part of your question, you asked me, how do you allocate capital in an environment like that? Well, it's very simple. It's commodities and gold and crypto, and you're basically short bonds. Now, that's in theory. What should be working. And at the moment, it's not really working. Okay, so we can talk about that.
Yeah, I mean, isn't it though, or are we just in a bit of a cool off year? Like, yeah, gold was not a great place to be for the last year, but it was a great place to be in 2020. And, there's this, it was a frothy market, maybe too frothy. I don't know. I'm pretty exposed to the resource market. And, I see a very temperamental retail attitude there, where in years like 2020, when it's super frothy, everybody loves it, right? And as soon as we get a bit of a correction, people think the system's broken. I'm like, no, it's just not easy money right now, right? But yeah, this is part of a longer trend.
I had somebody ask me the other day, this is a guy with a big position in metals, and this is after PPI printed 9.6% and metals went down. And he said, what inflation number does it take to get metals to go higher? So I wrote back to him, 4%. And he's like, are you messing with me? I'm like, no, actually, I'm not messing with you, because when CPI was at 4%, we were in the beginning of this inflationary psychology, and it was beneficial to commodities. And now that we're later in the cycle and we're starting to price in rate hikes, it's actually, it's like 9% inflation is actually counterintuitively, it's actually kind of bad for commodities.
Can you elaborate on that for me?
Well, I mean, it's all about monetary policy, right? So it's about the reaction function of the Fed relative to inflation. You see, the thing with inflation is that in the last 2 months, inflation has become a political issue. Okay. Like, you have elected representatives that, are seeing the poll numbers about inflation, and they're up for re-election in 2022, and they know they're going to get voted out of office. So they're going to the Fed and they're saying, do something about inflation. Right. So now, what I've been saying early in the pandemic is that the Fed isn't going to do anything about inflation until it becomes a political concern. And the Fed hates to be embarrassed. And right now they're embarrassed. And Jay Powell, who is, at this point bulletproof because he's entering his second term, he doesn't want his legacy to be the guy that allowed inflation to rip while he was Fed chair. Right. So you're going to see, we had the Fed meeting today. We're pricing in 3 rate hikes in 2022, 3 rate hikes in 2023. We're going to get more than that. The Fed is going to get progressively more aggressive.
So for context, today is December 15th. Jared just mentioned the today. So talk to me about how that impacts your average consumer, your average retail investor. We package in 3 rate hikes, if not more, from your standpoint in 2022, 2023. How does that impact the average retail investor's decision-making, where they may want to put cash, the average consumer's life, et cetera, et cetera?
Well, this makes the stock market very unappealing. If we're entering an aggressive rate hike cycle, I mean, the yield curve is the undisputed heavyweight champion. Okay, if the Fed hikes rates to 2% and 10s are at 1.5%, we have an inverted curve. That means we're going to have a recession sometime in the next 18 months, probably sooner than that. And it's happened every single time the curve is inverted. The last 8 times, it's 8 for 8. So, looking at the stock market today, like, it scares the hell out of me. It absolutely scares the hell out of me.
And when you say recession, do you mean stock market correction?
Yeah, absolutely.
Yes.
Yeah.
Okay. So because it's funny, normally you might gravitate towards economic recession, which we're in. No, I mean, these things are decoupled from one another. I think the economy and the stock market aren't playing the same game, or at least playing by different rules. So when you talk about recession, you're talking about a stock market correction. Yeah. Okay.
Yeah.
Okay. So right away, I hear that. And I go back to your earlier recommendation, look at commodities, look at gold, look at crypto. Does that still, that's where I would go with my cash. You would do the same?
Yeah. I mean, I think if you could just, build an asset allocation. See, the asset allocation I like to use, I call it the Austin portfolio, which is 20% stocks, 20% bonds, 20% cash, 20% gold, and 20% real estate. And that's an asset allocation that works all the time. It basically gives you the same return as stocks with half the volatility. Okay, just using that asset allocation. But you can take that as a baseline and you can say, okay, I'm going to overweight gold and I'm going to overweight real estate and I'm going to underweight stocks and underweight bonds. And just by making small adjustments to that asset allocation, they don't have to be big adjustments, but that's going to make a big difference in returns.
Okay. So do you think there's, I don't know if I've ever seen I've never seen so many new investors pile into the equities market, right? And this euphoric drive towards day trading, swing trading, et cetera, et cetera. So do you think there's going to be a big reckoning then, of new money in the market, new investors who've entered the market in the last 18 months? And we've seen this wave on the back of Reddit trends and et cetera, et cetera. And if you've watched the market for the last 12 years, what do you know about markets? They go up, apparently, right? That's all they do, right? They correct a little bit, then they go up again, right? And so what's the consequence, you think, of a ton of new money that's entered the market and they have to live through their first real severe correction that doesn't bounce back immediately?
Yeah, I mean, so I'm 47. The year I got in the business was 1999, which was in the .com bubble.
Yeah.
And I was in San Francisco at the time, and I was on the floor of the P-Coast on the options exchange. But I my day job is I was a lieutenant in the Coast Guard, and I was in this Coast Guard office, and everybody in the Coast Guard office, all these government employees were trading stocks. Government employees, day trading, in the middle of the day. And, there were in my office at the options firm I worked for, there was actually a day trading shop. Within 6 months of the top, those guys were out of business and they were all gone. So, back in January when the GameStop thing happened, I was pretty much long up until that point. And that scared me to death. When the whole Wall Street bets thing and they piled into GameStop, I said, this is it. You have massive amounts of retail participation. And I really, really lightened up at that point. So, yeah, I think we're going to get the second iteration of that this year. I think a lot of the millions of new people that entered the market, they're going to become very frustrated and they're going to stop trading.
And do you think they stop trading for good, turn their back in the market, say, it's not for me, this thing's rigged or whatever? Or do you think they get smart? I run this and I love the wave of new money that I've seen come into the market on the back of GameStop or whatever. But what I hope, and maybe this is optimistic of me, is that people are turning their attention towards taking control of their financial future, right? Not just relying on a salaries. They're looking for external places where they can generate wealth, whether or not they're misled into trendy Reddit stocks. Neither here nor there. We all make bad decisions when we begin anything, right? But my hope is that this is a good sign for people that want to take control of their wealth. But do you think I'm out to lunch on that one? What do you think?
I think I'm more pessimistic. So
everybody else is. Yeah.
So I think if you go back to like 2016, 2017, people were getting involved in the market for the first time, but they were doing it the right way. They were opening accounts at Vanguard, and they were buying mutual funds, and they were dollar cost averaging, and they were long-term investors. And sometime between 2017 and 2020, and it's funny because I don't know if you remember that period of time, but there were all these debates about passive investing and active investing, and how passive was like 50% of AUM. And, it was becoming very hard to pick stocks, and all these people were pissed off at passive, and nobody talks about that anymore. Now it's all active, right? Now everybody's, day trading. And, one of the things that led to this was free commissions. Schwab was the first, Robinhood was the first to have free commissions, and then Schwab went in like October of 2019, and then all the other brokerages went. But free commissions are very, very bad. They're very bad. Like there have to be transactions costs associated with trading. And a lot of people looked at this and they said, well, this is great for individual investors. But it's not, because if there's no friction associated with trading, it's kind of like a buffet. You tend to over consume free goods. And that's the problem with zero commission trading, is that people over consume free goods and they just chop themselves to bits.
That's really interesting. Yeah, you do remove an important obstacle that may add just some additional thought, right, to that decision before you make it, right?
Yeah.
What are some of the most common mistakes, Jared, that you are seeing investors make right now?
Probably the most common is that nobody is taking profits. Okay, so people have positions in Apple and Nvidia and Microsoft and all these stocks that have gone up 300-400%, and they really don't want to take profits because they are scared of leaving money on the table. And the other thing is that when your cost basis is so low, I mean, if you have a stock that's up 1,000%, even if it goes down, you don't care because you're still up 500%. So the phenomenon of people having a low cost basis and not wanting to leave money on the table means they're fully invested in the stock market, and they're going to be, we'll turn lower and they'll go with it.
Yeah, well, there's a bit of a culture thing there, right? With like the viral diamond hands, emoticons, and all this stuff.
Yeah.
A lot of like pride online in holding through volatility, which has its place. Absolutely. I'm not saying that it isn't, but there's a bit of like an evangelical love for people's positions that I'm seeing online. And I wonder if that's a consequence of, like, say you're following a sports team and you've got your loyal fans who have been there for 10 years, right? And maybe because they've been through wins and they've been through losses, they've been through upsets, they've been through all of it, they're less, more pragmatic in their forecasts for the team. Whereas the newer bandwagon fan who jumps on when the team's on a winning streak doesn't know anything different and can't imagine their team would ever lose. And I've seen sports fans in that regard get hurt far greater if they're newer to the sport, right? The bandwagon fans get hurt the hardest because they can't believe things could go the opposite way than they've gone. And there's some parallels there probably to new investors in the market.
Well, what you're describing is the phenomenon of drawdowns, right? Like if you have a sports team and it has a losing streak, what you're experiencing is a drawdown. Okay. And if you've had somebody that's held a stock through a number of drawdowns, and they've survived every single one, it reinforces their confidence. It actually makes them more confident in the stock. But drawdowns affect psychology. I mean, this is why people invest in hedge funds, because hedge funds don't promise the greatest returns, but they do manage risk and they manage drawdowns. So, if you're invested in a fund that has a max drawdown of like 9% a year, you can stay invested over the long term. It's when you have a large drawdown, then it shakes everybody out and you have people that sell at the bottom.
Yeah. Okay. So let's get back to people don't sell. Biggest mistake investors make. People don't take profits. The trap that we can fall into there is, you hopefully do some diligence in a company, become convinced this is a good buy, right? There's lots of upside there and you believe in the management, whatever that is, right? You make the purchase, right? And then your thesis is proven correct. The share price increases. The company did what you thought they were going to do. And this adds conviction to your initial thesis. So in theory, I was right here, but now the share price is here. I'm more right than I was back there. So my conviction deepens, right? And I'm potentially less likely to lighten up, because if I was right in September, man, am I ever right in December, right? And so how do you manage that psychological roller coaster, the emotional roller coaster?
Reinforcing confidence on the way up. Let me just tell you a quick story. I was talking to a friend of mine. He called me up, and he kind of relies on me on financial issues. And he owns Apple, and he owns like $300,000 worth of Apple. Now, he's not a super wealthy guy. It's probably 30 or more % of his net worth. And, he's come to the point where he's psychologically ready to take profits. But if he does, he has a big tax bill, right? So he has to pay taxes. But on the other hand, he has a problem because he has one stock that's a big weight in his portfolio, and he needs to rebalance. He needs to sell Apple and buy other stuff, because otherwise the returns of the portfolio are just dominated by Apple. Okay. So this is a guy who, it's funny. His instincts are good, I think. I mean, selling Apple at a 3 trillion market cap is, if you don't, you're betting that it's going to go to 4, 5, or 6. So I think his instincts are good, but he has all these other problems.
Yeah. Well, that's, there's a couple things at play there, right? Like, number one, it's been a fun ride. It's been fun, right? And you want to take yourself out of that game. Like, there's some resistance to that, right? I'm on the team. Yeah. I'm on the winning team. I don't want to jump off the team. And then secondly, probably some self-doubt. Like, you picked a winner. Good for you. But, if you exit that position, you exactly have to reallocate that capital into something else. And the thought, like, but can I do this again? Or should I stick with the winning team? Like, what's the likelihood I'll find another winner like this, right?
I know. Yeah. I like to take profits. I have a bias to taking profits, and, I'm a long-term trader. At a minimum, I hold stuff for 6 months and usually for 2 or 3 years. Yeah. But at the same time, like, when it's time to take profits, I take profits. And my philosophy is there's always something else. There's it's cliche, but people say there's always a bull market somewhere. There's always something else to invest in. Yeah,
100%. What I say is there's a new bus every 15 minutes, because you're right.
Yeah.
my brother came up with that quote. He was talking about a dating app, but same thing regardless in the market. And, our time horizon is like exactly the same. Well, similar, 6 months to 2-3 years. I'm very much in there. 6 months to probably 2 to 5 years, because I play in the mining space quite a bit, which just has a longer, sometimes can have a longer waiting period. But I love how you refer to yourself as a trader. And then you said your time horizon was 6 months to 2 to 3 years, because was that conscious that you identified as a trader as opposed to an investor, Jared? Or was that just?
I think I said I was a trader because that's what I did as a job. Okay. That was my job for 9 years. So
got it.
And it's funny because, like, once you're a pickle, you can't go back to being a cucumber. Like, if you've been a trader, like, you look at the world in a certain way, and it kind of defines who you are, and everything becomes transaction oriented. So I am a trader. But for the purposes of, like, what I do in my career with my newsletter, it's not a high frequency trading newsletter. It's long-term trades. So.
Okay. You know what? I'd love you to share a few words with some of my viewers who are, in the swing trading world, and they're there because they entered the market in the last 18 months, and there's been some easy money to be made, right? And a lot of camaraderie and all of this. And, what I try to communicate to people is that traders eventually get beat, and that doesn't mean everybody does, but as a general rule of thumb, the legends that I maybe aspire to be like, look up to, or have learned a lot from, are long-term investors, right? That spend a bit of time making a decision, have conviction, and hold, right? And I want you to share some thoughts on that. Is that poor advice? Am I out of place? First of all, sharing that I recommend people take a longer term approach and buy and hold things. And what would you say to somebody in that scenario?
Well, I think it's very dependent on the environment. I think certain environments are conducive to day trading or swing trading, and some environments are just tougher. And we were in one of the environments that's very good for day trading. Quick story. There was an academic study that was done of day traders in South Korea. And this is, I think it was like 2013 or something like that. So they took 1,000 day traders and they watched them over time. After 6 months, 90% of them had given up. 90% of them had quit. So only 10% were left. After 12 months, only 1% was left. And that 1% only had enough money to pay their rent and their food and stuff like that. It's very, very tough. And we're just in an environment where you have very strong trends and stuff goes up forever. And, you feel like a genius, but it's really a function of the environment that they're in. And at some point, this regime is going to change and it's going to get a lot harder.
Yeah, that's a fascinating stat. I mean, I'm not really surprised, but I guess it reinforces what I was sharing and maybe why I tell people to proceed with caution and patience more so is because if you want to succeed at generating wealth in the market, it is a lifelong endeavor. And, you shouldn't expect immediate results. But frequently today, people look at the market as a get rich quick scheme. And in my experience, at least in the speculative market, it's far more frequently a go broke fast scheme or a get rich slow scheme, right? If you have the patience and the discipline. And step one, I always recommend is like, okay, first of all, just determine how much time you have to invest in being an investor. And that will tell you a lot about what kind of investor you might be. And I didn't mean to like shit on traders at all, because I know some great ones, lots, and many have been on this show. But it's a more serious and timely endeavor than people realize sometimes. And, what I tell people is like, what kind of time do you have on a consistent long-term basis to invest, right? Is it 2 hours a week? Like not just this month, but what's realistic for you to come back again and again and again? Because then everything compounds, right? Not just your money, but your education, your skill, right? What you see, right? Et cetera, et cetera. What do you think about that?
I gotta say I've never audited my returns or anything like that, but if you did, it would not be impressive. Maybe 12% a year, something like that. It's not amazing.
Okay.
But, what I've been very good at doing over the years is conserving capital and being very safe and avoiding mistakes, right? Because mistakes are very difficult to recover from. Like if you lose 50% on a stock, it has to go up 100% in order for you to make your money back. So it's crucial to avoid the mistakes and also buy the insurance, buy the puts, insure the portfolio and makes, because the worst thing that can happen is the zero.
Yeah, 100%. That's really important to recognize that if you bought at $1 and you're down 50%, you're at 50 cents. So to get your money back, it's not 50%, and you got to gain back. It's 100%, right?
Yeah.
And that's important math to do. The probability of that occurring. What's the probability? When you bought it, do you think you had potential for a 5x return? Because if you bought it $1 and it's at 20 cents, now you need that 5x return just to be flat, right?
Yeah.
And but loss aversion is a real thing, right? Like it's really difficult to just take that loss and be like, I'm going to be the idiot who sells at the bottom, right? I can't afford like all this stuff, right? And it's not even about, I guess, accepting the capital is gone, but that we all know stories about people who sold at the bottom because they got scared. And so balancing that's tough, right? Where you're in a position, market corrected, now you're down 80% of your money or whatever. I mean, I'm sitting on positions like that right now with some junior mining stories that management teams I trust and respect and have got a couple exits in their past, and I will stick with these individuals, but it's been a tough year for that sector, right? And this market is down. And so I'm looking at these positions now saying, what's the path forward here, right? Do I love the story as much as I did in the summer? Because if so, I should just be buying more. But, I think that's not always the case. Sometimes you just need to get out because something changed, right? And you shouldn't have the conviction you used to have. But then, the thought that like, I'm going to be the idiot who sold at the bottom probably prevents a lot of people from getting out of positions they should, I would imagine.
Yeah, no, it also applies to shorts. It's like if somebody short a stock and it's going up, they won't cover the short because they're like, well, I'm going to cover at the top. As soon as I buy back, it's going to be the top tick, same thing.
Got it. Okay. So you have a super diverse portfolio of activities, right? When we jumped in here, we talked about the letter, the daily Dirtnap. You do some writing for Mauldin Economics.
I forgot to mention I'm an opinion columnist for Bloomberg.
That's right. Yeah. I knew that. What kind of opinions do you write?
It's mostly financial stuff. I do politics every once in a while. A lot on Wall Street culture. I write a lot about that. So.
Okay, give me some bullet points on Wall Street culture.
Well, probably the biggest piece I ever did was about the CFA exam. And I wrote in a piece that it was a colossal waste of time.
Okay. Why is that?
So, I'm not sure I want to read. See, this is you talking about like conflict and controversy. Yeah. My life just like blew up for a week. I mean, half the people agreed with me, and half the people who had CFAs disagreed with me.
Yeah, it's a big endeavor. It's a big undertaking.
Yeah. Basically, what I said is that, you know, because I took 2 levels of the CFA, I failed level 2 and then I just quit. Okay. I said it really felt like I wasn't learning the material. I was learning how to pass a test. You know what I mean? Mm-hmm. And, you know, I'm in grad school right now and I'm going there to learn. And this did not feel like learning. It felt like rote memorization. Yeah. I mean, it's really like a medieval way to learn, and people cram, you know, all these equations and stuff into their head, and they take the test and they walk out of there and they forget it forever. I was like, it's not a good use of my time.
It's interesting because it's the obstacle to becoming a CFA, but the learning happens when you become a CFA, more than likely.
Well, the learning happens on your job.
Right. Not studying for the exam. It's getting past that obstacle. That's why you think it's a waste of time, because you study for the exam to pass the exam, retaining very little because it's an exercise of memorization, right? Not skill acquisition. And then you get on the job, and that's when you learn how to be a great CFA.
Yeah.
That's why it's a waste of time. Interesting. Well, there's many careers like that. And then what I have to ask, you said an MFA in creative writing. I don't know what an MFA is. Master
in Fine Arts.
Oh, okay, of course. That's a dumb question. Yeah, there it is. Right. Yeah, got it. You know, it's funny, your comments on it. You know, that component of, well, the CFA exam being exercise and memorization versus skill acquisition, because isn't that a big problem with our education system in general right now? You know, I got 3 kids. My oldest is 5, right? 1, 3, and 5. So we're just starting to think about how we're going to educate our kids. And my wife and I sat down and we had the equivalent of like writing a 1-page business plan for our parenting, right? Complete with core values and like mission statements. And, you know, if we succeed as parents, what is it that we instill in our kids, right? What are the values that we instill in our kids? And we came up with creativity, which I think is just, you know, timeless, right? And confidence. I believe without confidence, sometimes people don't action their creativity. You need both, right? And the third is an understanding of the relationship between hard work and reward. Because I don't know. Do you have kids?
No, I have 6 cats.
Yeah. All right. Well, maybe cats are the same. I don't know.
It's kind of the same. Yeah. We've raised pretty good cats.
Yeah. And trying to communicate the importance of suffering, right? The value in doing something hard for the reward at the end. It's a tough thing to communicate to a 5-year-old, right? So how do you teach that? You know? And so to date, we've just opted out of traditional education, and my 5-year-old goes to a complete outdoor, he's kindergarten, so it's all relative, but kindergarten where there's no classroom, he spends the entire day outside, 5 days a week. And I live in the Pacific Northwest, so it's like really rainy, cold, and wet many months of the year here. So it builds like tough, resilient little children. But simultaneously, you know, there's this heavy emphasis on free play and therefore problem solving and conflict resolvement, because a lot of it's unsupervised, like very, very unstructured. And I think that I'm going to hold him back. We do academics at home, but hold him back from traditional academia as long as possible.
Yeah, that sounds pretty. I mean, it sounds like, you know, going to elementary school when I was a kid. You know, yes. we had recess and, you know, unstructured play, you know, free time and conflict resolution and, you know, did all that stuff. Yeah, for sure.
Yeah. You learn through doing. And yeah. Okay. And then I'm really curious about the DJ front. So is this just a passion, or like talking about this?
So I started this in 2008. When Lehman went bankrupt, I was like, screw it. And I bought top of the line DJ equipment, and I taught myself how to DJ, which actually, you know, it's interesting. DJing is one of those things that looks easy, but is actually really hard. And I think there's some things that look hard and are actually really easy, like ski jumping. Like I think ski jumping is actually really easy, but it looks hard. But DJing is super, super hard. And it took me a long time to learn. But I've always been, I love to perform, and I've always been very aggressive about getting gigs. And I'm super busy nowadays, but like I said, I still play 3 or 4 times a year, and I love it. I play progressive house music. I love the music. I've been a musician my whole life. I played a bunch of instruments when I was younger, and, was drum major of the marching band twice and stuff like that.
Really? Okay. I played drums in a marching band too. That's hilarious. Yeah. Had a whole kit. You ever play in a band, like a rock band, full kit thing?
No.
Okay. Yeah. Got it. So if you had to spend all your time in one of these buckets, Jared, as the writer, as the investor, as the entertainer, the DJ, would you gravitate towards one?
I think if I had to choose, I would spend a little bit more time as a DJ, but not a lot. I kind of like the way I allocate my time right now. I love writing, and when I write my newsletter every day, it's just a joy. I'm very lucky. I'm very blessed because I get paid pretty good money to do something I love. And, I'm here in this office, I'm here all day, and I write, and it's awesome. So, I'd like to play a little bit more music, but I actually like the way I spend my time right now.
Why go after the MFA, the Master in Fine Arts in Creative Writing? You've got the career, you're already a writer. What's the motivation to get that ticket?
So when I graduated from college, I took a couple classes in fiction that inspired me in college. And when I graduated, what I wanted to do was I wanted to get an MFA, and I wanted to write short stories, get them published in anthologies, and I wanted to be a professor. And I was just like, that's what I wanted to do. And my mom said, that's a terrible idea. She said, you're going to be poor. You need another plan. She said, that's a terrible plan. So I just completely switched gears, and I ended up getting an MBA instead and went to Wall Street. But I always had this dream of getting an MFA back from when I was like 22 years old, and I never let go of the dream. And that's why I'm doing it right now. So. Okay.
And you've written a couple books, right?
Yeah. 2 books.
2 books. What's the general thesis of each?
So the first book was a memoir. It's called Street Freak: Money and Madness at Lehman Brothers. It's really about Lehman Brothers. It's about my time at Lehman and also my struggle with bipolar disorder. And the second one was a novel called All the Evil of This World, which is about a trade that takes place during the dot-com bubble. That book is unbelievable. It's the best thing I've ever done. I spent 5 years on it. It's called All the Evil of This World. I love that book.
When you say, okay, All the Evil of This World, we can find it on Amazon. I haven't read it. I love to read the books before I have the guest on. I didn't do that this time. Didn't do my homework.
That's a lot to ask. It's okay.
But I will check it out, and we'll add a link so people can check it out too. I'll find it online. When you say you took 5 years to write it, was this like a writing hiatus? Was it a full-time endeavor, or was it part-time? How much time?
I was writing it nights and weekends, but fiction is very, very hard. And I'll never write another novel again. I've done a lot of hard things in my life. I went to a military academy. I've run marathons. I've done all kinds of hard stuff. This was the hardest thing I've ever done. And it took me 5 years, and I was really a perfectionist about it, and it had to be perfect, and it is perfect.
What was the hardest part about it?
Well, the problem is that I picked basically the highest degree of difficulty that I could possibly pick, because it's not like a linear plot. It's almost like 7 short stories that are intertwined. So there's a lot of engineering that goes into the book, because some chapters refer to other chapters and it's all connected. So I really picked the hardest thing possible.
That's why fiction would be harder, because you're having to interweave narratives and lives and all of these stories. Yeah. Okay. That makes sense. Writing a book is on my 3-year bucket list. And, when I think about time investment, I'm like, I can't imagine. I write, I publish a weekly newsletter. Similarly, I love it. It's maybe the favorite thing that I do. And I'm just releasing an ebook right now, which is kind of a collection of just like major takeaways that I've had, and I'm enjoying that too. And the blueprint for a book is sitting on my computer, and I'm like, I need to find a way though to structure like a 6-month hiatus where I can just attack that exclusively and remove as many distractions as possible. I don't know how I'm going to do that though. That's why I was curious about, 5 years was this full time, like how much, because it's hard. Okay. I want to get into a little bit about your personal portfolio before we wrap up. So, let's get back to some of the, recommendations, things you mentioned earlier. You said in this, we're looking at inflation being a long-term trend, 10 to 20 years is what you stated as long-term. Safe spots for capital in that environment, crypto, commodities, and gold. So how do you structure your crypto holdings? Are you hunting for altcoins? Are you just sitting on the bigger, more proven opportunities? Talk to me about that.
So I have a theory about this, and you're going to love it. Okay. So, 2000 years ago, what did the financial system look like? It was basically just gold. People had gold coins, gold bars. It was all gold. And then over time, and this was a long time, you have to get to the 1400s before you had tradable debt and fractional reserve banking, and the financial system became more complex. And then in 1605, you had the first stock. You had the first publicly traded company. And then as time goes on, bond markets get more complex, stock markets get more complex. And you fast forward to 15, 20 years ago, and you're slicing and dicing debt a bunch of different ways. You have CDOs and credit default swaps. And the point is you have increasing financialization over time. Like over time, the financial system gets more and more complex. A lot of people say this is a bad thing, but it's actually a good thing, because really, like, human progress tracks financialization over time. Like, things have gotten better. So with crypto, when Bitcoin, what year did Bitcoin come out? 2010? Is that right?
About that. Yeah. Right after the crash. Yeah.
So in the beginning of crypto, all there was Bitcoin. Just like 2000 years ago, all there was gold, just an absolute store of value. And all there was Bitcoin. Then over time, you began to introduce some altcoins. And what you're seeing is that the market cap of Bitcoin as a percentage of the market cap of all crypto is going down over time. Doesn't mean that Bitcoin is going down. It just that means the other stuff is becoming more valuable. And what that actually is financialization in the crypto sector. I mean, you have blockchains that do different stuff, whether it's Avalanche or Polkadot. With both of those I own. But you have blockchains that do different things. And, the Bitcoin people say, well, those are shit coins, right? Well, if you think about it, stocks and bonds, a company can issue more stock, a company can issue more bonds. It doesn't stop people from buying the stock. Like, just because you can have dilution doesn't mean that it's a crap crypto. It means that it has utility. It has cash flows. In some cases, it does different stuff. So what I think is going to happen is that over the next 10 years, you're going to have increasing financialization in crypto, and Bitcoin will get smaller and smaller and smaller relative to all the other stuff.
Interesting. That makes sense if you follow that trend. Now, I guess my question would be, what gives you the confidence? Because it's a big comparison to compare a 13-year-old asset with a 5,000-year asset and say that the path forward will be the same. So my question for you then, Jared, because I probably agree with you, but what gives you the conviction to say the same thing will happen to Bitcoin, as in more and more other cryptos will be financialized?
Well, it is happening. I mean, we're seeing it. And in terms of my portfolio, like, I actually don't have Bitcoin, but I have a bunch of other stuff. And really what I would like to see, like, this would be awesome. So we're talking about developing ETFs for Bitcoin. So now there's a Bitcoin futures ETF. The best financial innovation of the 2020s would be a crypto index ETF. Just an index fund that invested in all crypto. So, because most people don't have the sophistication to pick individual coins. They just say, I just want to own crypto as a blob, just like people say, I want to own the stock market as a blob. Yeah. So if you had a crypto index fund that traded as an ETF, it'd be huge.
Interesting. I wonder why that doesn't exist yet.
Well, there's a lot of steps to go through between now and then.
Okay. Okay. So you don't own any Bitcoin. You own a handful of these other assets that you feel like are on the come up, Does the like evangelical amount of froth in the crypto market give you any pause? Does it temper your enthusiasm in the near term a little bit? Or do you think it's irrelevant and this is going the way it's going?
I think sentiment in crypto is a little bit elevated, but it's not as elevated as I've seen it at other points. Like January of this year, like sentiment was very elevated. When it hit 64,000, it was very elevated.
Yeah,
I think sentiment is kind of neutral right now. This has been a pretty big correction, So I think it's taken some of the froth out of it.
Okay, now your thoughts on like the NFT space and the Metaverse space. I see some parallels to back in 2017, the first Bitcoin rally that really turned a lot of mainstream heads. And I was running a technology investment conference in Toronto, and essentially blockchain investment opportunities just ate the entire conference, right? That was all anybody wanted to talk about.
What year was this?
That was September of 2017.
Oh, of course, yeah.
Yeah, and that was when Hive blockchain went public, and I think they went public at 30 cents, ran to $6. The market lost their mind. But that was the tail end of that Bitcoin rush, because by January 2018, it fell off a cliff, right? Entered what people know as crypto winter, right? Anyways, during that period of September to Christmas, more or less, ICOs were popping out left, right, and center, and everybody was trading ICOs. Pure speculation. I love speculation for the sake of speculation, but it had gotten stupid frothy. Do you think we're there right now with the NFT boom? Like, do you see parallels there where right now everyone's just rushing in on pure speculation, making a ton of money? But this has to be reconciled.
I think we were there a couple of months ago. Okay. Some of the NFTs that people bought were, just people buying pictures of rocks and stupid stuff for like 6 million. Like, I think that was kind of the top for NFTs, but like NFTs are just an incredible technology. Like, I'm a big believer in NFTs. The ability to create property rights with digital works where there were none previously, because by definition, something that's digitable can be reproduced an infinite amount of times. So your U.S. copyright law doesn't even know how to handle this. So you're creating basically property rights where none had existed. What's interesting is that I'm building a house and it's going to be bigger than the one I'm in. So I'm thinking about art, right? And I'm thinking about buying some NFTs, and I'm looking at really well-known digital artists, like very good digital artists, and their NFTs are trading for like $600, $800. Like, it's really cheap. So I think over time, what'll happen is that all the crap, like the penguins and the rocks and the robots and all that stuff, I think that's going to go away. But I think the potential of this technology will be realized. And, of course you had the Beeple, the picture, like, which was sold by Christie's and stuff like that. But what you'll see over the next 10 years is that, real digital art or other digital works will increase in value a lot.
And can you share at all? Because I call myself like a super novice in this space. What would give you a hint that one FT would be more valuable than another, or have staying power, like down the road, long-term value?
It's kind of hard to describe. I mean, it's kind of like traditional art, right? Like, if you think about the traditional art world, what makes one artist's work more valuable than another artist's work? I mean, a lot of it's determined by critics, but it's really determined by the market, and it's very difficult to predict. But I don't know. I mean, the answer to that question is I have no idea. Like, I just don't know. But that's
Sure. So chalk it up to discretion, right? I mean, that's why the art world functions, right? It's okay. That makes sense to me. Do you have any investments in the metaverse, Jared?
No, I haven't gone there yet. No.
Interesting. Have you explored?
I just read some stuff, but I really don't know enough to speak intelligently about it.
Right. Okay. I was checking out Decentraland yesterday, just kind of walking around, having a look around. What's in here? Yeah. All right, cool, man. Look, this has been fun. Thanks for making the time. Where are we at here? Daily Dirtnap on Twitter. Where can we send people for your newsletter, Jared?
Go to www.dailydirtnap.com. Very humorous website comes up. There's a nav bar on the left. There's a button that says subscribe. Actually, what pops up when you hit that button is just an email, and you can email me and we can chat, or you can get a subscription or whatever. But that's how you subscribe. All
right. Yeah. Join the team. Over 100,000 investors tune in. All the evil of this world. Going to check that out too. This is what Jared said is the best thing he's ever written. So got to read it. Yeah. All right.
It's really not safe for work, just to warn you. It's
okay.
NSFW. Yeah.
NSFW. It's a book though. Is it a picture book? What are we talking about here?
No, I mean, it's probably the filthiest book you've ever read in your life.
So, fascinating. Well, that's the best pitch ever.
Yeah.
Amazing. All right. Look, man, I will see you on Twitter. It's been great, Jared. Thanks so much for coming on.
All right. Thanks.
Okay, guys, 3 last things. First, if you enjoy my interviews and would like a bit more, you can subscribe to my Friday newsletter. It's free, and the comment to subscribe is right beneath this video in that pinned comment. In this newsletter, I share my key lessons learned, takeaways, and any actions that I might be taking in the market as a consequence of what I've learned on the show. Second, when I started a YouTube channel, I never anticipated generating any advertising revenue. But coincidentally, I do now, which is awesome. And so what I've decided to do is donate this to an organization that is very close to my heart called Zero Ceiling. Their mission is to end youth homelessness. The way they do this is by providing young people experiencing homelessness with supportive housing, employment, professional support, life skills, and outdoor adventure. Because often young people in urban centers with no resources will never get the opportunity to experience wild places, nature that can be so transformational, and absolutely was for me. Third, if you prefer to listen to my content, you can now find us wherever you listen to podcasts. Just search for The Jay Martin Show.